Every week, billions of euros move through European banks in the service of money launderers, fraudsters, and organised criminal networks. We know this, regulators know this, and banks know this. And yet, the institutions that hold the data capable of stopping it are somewhat legally paralysed, or so they think. Today, we're busting 5 of the biggest legal myths that are preventing the financial sector from doing what the law now actively enables: sharing intelligence, collaborating across borders, and actually stopping financial crime at scale. My guests are Taavi, founder and CEO of Salv, Diana, legal counsel at Salv, who spent years navigating the complex intersection of GDPR, banking secrecy laws, and the incoming EU AML regulatory package. My name's Dr. Nicola Harding, and this is Follow the Money. Today we're going to work through 5 myths, and for each one, I'll name the myth and we'll explore why it persists. And then Taavi and Diana are going to tell us why it's wrong and what the law actually allows. So let us get into it. And we're going to start with myth number 1, and that is that GDPR makes data sharing between banks illegal. This is the myth I hear more than any other. A compliance officer or a DPO says we cannot share customer data with another institution because of GDPR. Full stop, conversation over. But Diana, you must hear this constantly. So let's start with this. Is GDPR actually a barrier to intelligence sharing between financial institutions, or has it become somewhat of a convenient excuse?
GDPR is not a prohibition on intelligence sharing as such. It is a coexisting different framework that specifies the condition for any personal data processing activity and the condition under which sharing would be lawful. When we speak about intelligence sharing, lawful basis and GDPR are the top discussions in every conversation, and one of the 2 lawful bases under the GDPR always come into play. That's the legitimate interest and compliance with legal obligation. Lawful basis was always there. Article 6 under the GDPR and Recital 47 explicitly recognize fraud prevention as a legitimate interest and a qualifying purpose. And then there's PSR and PSD3, which have already passed political agreement last year, November, which fundamentally changes how institutions are expected to approach fraud detection and prevention. And this is also not only a permissive safe harbor for data sharing, but also a mandatory obligation that we will delve more deeper into throughout today.
From what you said, Diana, that means that whilst there's no restrictions, there's actually even more of a legal emphasis to do so now. I guess that means there needs to be some honest conversations within the bank or financial institution with the data protection officer. So moving on to myth number 2, I think we've established that even if GDPR does not block sharing, that actually there's many banks, particularly in Central and Eastern Europe, that cite local banking secrecy legislation. So things like the Credit Institution Acts and strict confidentiality obligations with the fear of criminal liability for individual compliance officers. So myth 2 then is banking secrecy laws prevent us from sharing anything. My question, Diana, if you're okay to tackle this one, is that Salv's work directly with institutions in the Baltics navigating exactly this. How do anti-money laundering laws interact with national banking secrecy obligations? How does that dynamic work?
I think it depends how you frame the question. A lot of times I hear even legal commentators or practitioners framing the question, which obligation, banking secrecy or AML laws, which one wins, right? And that framing of the question, I think, is the root of the problem, because it assumes a conflict between these 2. And the first thing I want to establish is that AML obligations and banking secrecy are not really in conflict. We cannot conflate them as such. They are in a structural relationship, so to speak. One is more of a general obligation and the other is a specific statutory exception. So once you understand the structure of the relationship between this obligation, it becomes apparent that the conflict dissolves entirely. I would like to answer this question with actually an example, because I think in different jurisdictions, this question is tackled a little bit differently, because in the absence of EU level framework, we are struggling to give a very ambiguous answer to this, and that's understandable because at the moment the regulation is fragmented as per each member state. However, I think I would bring the example of Estonia, which I think has one of the most instructive legislation in Europe on exactly intelligence sharing versus banking secrecy. The baseline banking secrecy obligation in Estonia is stipulated in Credit Institution Act. Very simple, all data and assessment known to credit institutions concerning their client is obviously subject to banking secrecy. And then we have the AML law that provides explicit legal ground for piercing this banking secrecy to fight financial crime. And I think Section 16 of this Money Laundering and Terrorist Financing Prevention Act provides an explicit exception to a generic banking secrecy law. So the question who wins, I think neither framework wins because they were never in a conflict. Banking secrecy is a very important obligation. It protects customers from indiscriminate and unauthorized disclosure. And AML law, specifically data sharing under the upcoming AML regulation, provides purpose-limited and specific authority for data sharing in pursuit of financial crime prevention, and they can coexist entirely coherently.
I really liked your explanation there, Diana, to see how they can coexist rather than be in conflict with each other. I think one of the things that might be useful, if we can take just a short minute, would you be able to walk us through the distinction between EU regulation and a directive?
I think this is a very important question, and sometimes it may come across as technical, but in lots of discussions it has proven that it can have enormous practical consequences. But in a nutshell, when the EU legislates, it has two primary instruments at its disposal, a directive and a regulation. They both are EU laws. They are both binding, they operate across member states, but they operate fundamentally differently. And the difference that they provide is, for example, a directive sets out an instruction, a result that any member state must achieve, but it leaves the national transposition to each member state. And the transposition obviously takes time, it's subject to internal discussions in the parliament, and we come across to many of the practitioners called gold plating, where local parliaments don't necessarily include all the instructions in the directive and they under legislate. However, a regulation is a categorically different instrument. It has a direct effect and direct applicability across all member states. And the moment it is published on the official journal of the EU and the relevant applicability date arrives, it is a law. And in every member state, once it's published in Brussels, it's a law in Tallinn, it's a law in Frankfurt, Warsaw, and across the European Union. And I think building on this, historically, the European AML framework has been built on directives, and 6 generations of them, which all required local transposition, local execution, and the EU Commission understood that this has produced inconsistency, this has produced delay, this has produced siloed fight against financial crimes. The upcoming anti-money laundering regulation, not the directive, it has a direct applicability across entire European Union. No transposition process is needed. Once the date comes in July 2027, it will be applicable and the compliance obligations will start applying. Now, this is related to AMLR. The PSR is also a regulation. Also, we call them a package because we have AMLR and we have AMLD 6, and we have Payment Services Regulation, and we have Payment Services Regulation 3. The PSR timeline is also visible and approaching. As I said, we have achieved a political agreement last year, November, and are really looking forward to the final steps.
Really, really clear and helpful for us to understand that, Diana, I think, because it really just helps you to understand this relationship that you said, that not necessarily at war with each other, but more of a symbiotic relationship legally. Taavi, you've had to have this conversation with probably quite conservative general counsels, I should imagine. How do you kind of legally comfort someone who's genuinely afraid that sharing tactical intelligence will expose their bank or them personally to liability? What conversations are you having?
Fortunately, we have Diana now in the team who is actually backing me up at these discussions. But the thing is that once in our regular business work, once we get into the really direct discussions with legal counselors, it's already in really good stage. Because in this case, we can use the arguments, the structure, explain how it actually works, how we have documented, mitigated the risks. So at this point, actually, this discussion is very, very constructive already. To get to that point, that's much harder. So if I was speaking with the business people who quite often they don't understand what's the difference between regulation and directive or AMLR versus PSR or things like that. So it's like, how does the GDPR give us the right rules of the game and it's not meant to restrict. So to get through that barrier, I would say that's my job, and that's much harder actually to build the confidence and accountability in the business owners. Once we get into the legal counsel level, that's already business as usual discussions. One point I wanted to highlight earlier regarding to the Bank Secrecy Act, which is important to keep in mind, and I really recommend everyone to read your own Bank Secrecy Act or article as a part of the credit institutions. I was quite shocked to see that, yes, this article is there. It says that the banks need to protect their customers' data and keep it secret. One sentence. And then there are exceptions, which are like 20 different exceptions referring to if that holds, then banks can share data. And if the other thing holds, then you can share data. And reference to the AML laws, that's just one out of 20 things. There's also police and tax and customs, and many, many other organizations can get access to the bank secrecy. So I would say that the bank secrecy is a bit over dramatized. So in that context, this AML related data sharing, personal data sharing or banks, customers data sharing, that's rather rule than an exception when you read actually this particular article.
Brilliant. I'll move on to myth 3. And this myth is that sharing information between banks will constitute tipping off and is a criminal offence. So this one seems to genuinely frighten compliance teams. The fact that tipping off is a criminal offence and that alerting a suspect that they may be under investigation is a real legal risk. When banks hear collaborative investigation, many compliance officers may immediately imagine a scenario where a suspect finds out through a data that multiple banks are watching them. Diana, how does the law handle this? If Bank A and Bank B are both sharing intelligence about the same individual on the platform, like they can do on Bridge, are they at risk of tipping off?
I will use the same logic because same logic as in the banking secrecy and the intersection together with the data sharing. So we should start by explaining what is tipping off, because sometimes the staff has mentioned it's overstressed but not understood entirely. So tipping off prohibition generally in majority of jurisdictions is unlawful disclosure to the customer or any third party regarding 3 actions or so. First is that a suspicion transaction report has been filed regarding them, or an investigation is underway, and that information has been requested by the FIU. So this prohibition is a really important prohibition, and it's important for it because it protects the integrity of criminal investigations. But its target is the subject of suspicion, not the parties who might alert them. So there's a different legal act governing these different sets of provisions, tipping off and the data sharing. Upcoming EU-level frameworks like Article 75 of AMLR and PSR Article 83A expressly permit the interinstitutional sharing, and they are drafted precisely with the rationale behind them that the legislator understood that effective financial crime prevention requires information to flow between these institutions, and they just really coexist with tipping off prohibitions. Now, it's a different question how you can control this both technologically and with your internal controls. So, for example, only credentialed representatives of these member institutions should access the platform, and there is no pathway by which a customer or a third party subject to any suspicion can inform the suspect. So there are many different ways how you can protect this from being a tipping off, but whether a tipping off is a bottleneck or not, that's already collectively settled that it's not.
That's brilliant from the legal perspective and a great way of looking at it. Taavi, from a technical standpoint, how does Salv's bridge architecture make tipping off structurally impossible?
You asked in the beginning whether there is risk of tipping off. And my answer is that, again, of course, there is a risk of tipping off. Also, when banks are running their internal investigations without any data sharing, there is always risk. And they need to control this risk and mitigate these risks. Because like internally also, if AML investigators happen to give a hint or speak with the CS people or like the frontline people, KYC people, too openly, there is also a risk that they are leaking this information back. But there are like control mechanisms in place. And the same principles or similar principles are applied also in the data sharing case. So audit logging, pre-agreed governance structure in which cases the cases are being shared. Some institutions, depending on their internal risk appetite and internal compliance procedures, they are using like 4I principle. I think these are the main things. So basically format, like UI format, access rights, of course, as well. Like it's access rights and security standards are mostly built to keep the data technology secure against the third-party attacks, but naturally they also help against unintentional tipping off as well. And the truth is that like looking back 5 years of history and experience, of course, every bank initially or before launching and before joining, they asked the question, the risk of tipping off, and it used to be among the top 10 objections or questions that we received. After we launched and banks started to exchange information, I've never heard this question coming back again. They have their internal regular risk reviews, compliance, policy, procedural updates and everything. Regardless of that, there hasn't been any questions, which is ultimate proof that actually the risk is there, but it's really well mitigated by the current setup.
It always interests me that the risks that we consider is that when we're implementing a technology, we tend to focus the risks on technology, but actually the risks really often still very much remain with the people. And that you have to deal with mitigating those risks, like you say, through kind of cultural events and ensuring that banking culture means that, you know, tipping off is something that you kind of eradicate that way. You know, the platforms that you've built obviously are, like you said, they fit minimum security standards and higher. Banks remain data controllers, therefore the risk kind of, I guess, still sits with the bank, just because you're operating where you're sharing that intelligence. It's not like anyone from Salv is sat there reading that intelligence. They structurally can't. I think it's always good. And like you said, when people begin to use it and understand it, the question goes away because the objection becomes irrelevant because you can see it.
It's just basically you're referring to the point that the key is like how to handle this risk and how to systematically build up a technology and software and processes which are suitable for the banks. And the same question holds for every software provider that wants to serve banks for dealing with really sensitive PII data. So in that regard, data sharing, yes, it's a new thing, of course, and it's unusual and people need to get used to it. But it doesn't introduce drastically any new dimensional problems, but the current problems need to be dealt really, really well.
Yeah, that's a really, really good point and a great way to sum it up. For myth number 4 then, anti-money laundering compliance and fraud prevention are essentially the same problem, and we can solve them together. Now, this is a myth that works, I feel, in the opposite direction. So rather than preventing action, it causes banks to conflate two legally distinct regimes and build solutions that potentially could be non-compliant by design. So I'm going to go to you, Taavi, this time. How do you feel about AML and fraud? Do they need to be kept strictly separate in data sharing conversations? Are they the same problem? What do you see in practice?
Yes and no, or they are and they aren't the same problem. But depending on from which organization to look at, what's the background of the people. I've spoken to very, very senior top heads of AML, and they haven't heard about anything about BSR and mandatory reimbursement, and vice versa as well. And they are working in their silo, which is huge silo, as they're working in huge organization. It's understandable that they haven't had time to focus on other things which are out from their scope. And also, of course, like the similar seniority people actually are working heavily in the AML and BSR space altogether. It's really interesting. Last week I was at the UN ODC Global Fraud Summit, and there was Financial Action Task Force people who should be focused purely on AML, and they are coming into the scam fraud space really fast. So in old days, FATF didn't deal with fraud almost at all because it was just boring fraud stuff. And so basically, like this, every analyst and can explain that how the fraud converts into money laundering in the next moment. So it's like pretty classical, but still organizations are very, very static, and procedures are static, tools are static. And like when speaking about technology, then actually when we think about majority, I guess 95% of the financial institutions are using AML transaction monitoring systems, which are being provided by the old well-established companies. Right? But actually, if you think about needs which were there like 10, 20 years ago when these companies built their products, the nature of the money laundering was very different from the scam fraud type of money laundering. You had enough time to investigate for a full week or a couple of weeks to investigate the cases. The money laundering transactions were huge. They were in millions or tens of millions or like billions sometimes. So it was like number of these transactions, it was quite low. Speed was very, very slow. So the nature of the money laundering purely from the discovery point of view, it was like very, very different focus. And the thing today is that I think majority of these AML products which are being used still by the large institutions, these are not meant to tackle the scam fraud problem. So even if these people would like to find classical money muling or if the procedures would support that, then technology which they're using is not fit for that purpose, to be the real-time checks, monitoring transactions which look like normal transactions between the people. So they're missing this kind of competence, but they're also missing this kind of tools. And the same problem is actually also with good old school fraud products, which were meant mostly for the card fraud, maybe account takeover stuff. It was like always like the card holder not present, or this type of the fraud where the victims didn't approve or they didn't authorize the payments. And again, nature of these kind of fraud systems was actually quite different from the ones that we need in the today's space. So that's like, which is at least as big challenge as the training and processes, the lack of the tools covering this kind of middle part between the old AML and the old fraud. And that's something, again, where the data sharing need is coming in, but data sharing is not the only thing, only technology which is needed. There are also this biometric profiling and monitoring the personal device fingerprinting of the behavior and things like that, which are also new things which are being developed by different companies right now, which again weren't needed that much in the classical AML, and maybe they weren't that much needed in the classical fraud detection, but now in this middle part they are needed. And again, for me as a product person, it's super exciting actually to see how this new categories are popping up, and like people are innovating and they're getting so passionate into this product development space as well.
So myth 5 then is really about timing. We don't need to do this until the law forces us to. This position says the regulation is not fully enforced. The supervisors have not yet mandated it, and our peers are not doing it yet, so we will watch and wait. Taavi, you operate across multiple European markets. What does the wait and see position actually cost an institution, commercially, reputationally, or operationally?
I see that different countries are moving in very different speeds, or some countries are not moving at all. Some banking associations are running actively RFPs to find a solution provider already. Many of them have concerns that, okay, even if they find a solution for their domestic market, how they can be sure that this domestic market solution actually can speak with other countries, other regions, because reading the law, understanding, defining your needs for your own banking association members, that's not easy, but it's doable. But people feel uncomfortable that, okay, what if the rest of the European standards move in different direction and our well-selected solution doesn't fit into that? And that's understandable concern, right? And like, even if they do select provider today, they think that they're compliant. Maybe 2 years from now, they're not compliant because this provider is some strange company which doesn't speak with anyone else. So these are the natural risks. What are the solutions? Again, like Salv, bridge. We're offering bridge for domestic networks, but also we're offering bridge as a correspondent between the countries and between the networks to help people to standardize or to ensure that actually their network is connectable with others. And what's the risk of not doing is that as this new product approval process and acceptance, it takes 18 months actually from start till actually live. So we can count how many months they have left, and they don't have too many months left to start it. And if they don't, in the end, there will be fines from the regulators. But most importantly, when you speak about scam fraud, their customers keep suffering more and more. And ultimately, mandatory reimbursement will mean that banks will also start suffering for the losses. That's like very measurable impact that's happening if they don't move fast enough.
So thank you for joining me, Taavi and Diana. This has been a really interesting conversation, as always. We've had 5 myths and 5 very clear answers. The legal architecture for collaboration exists. The technology to do it safely exists. The regulatory permission, and in some cases, the obligation also exists. What remains is institutional will, decision by compliance teams, general counsels, and executive leadership to stop hiding behind myths and start building the infrastructure that the law is actively inviting them to build. So thank you very much for joining me today. This has been Follow the Money, and I'll see you next time.